Good morning, students. This is Financial Statement Analysis, Part 1. Let's go to your Wolf Den page and take a look at what's required for this particular lesson today. Okay, come over here. Okay, if you go to Wolf Den and look under Test 2 Material, the first thing I want to take a look at is a couple PowerPoint slides where it says Chapter 3, Part 1 that you need to know. Now, you had a quiz the other day on material, and it was a review of accounting, but there are a couple slides I want you to take a look at. So let me pull that up, and this is the material up at the top. Okay. This material right here. Okay, so let's pull that up. See if it's going to come up. Okay, it's taking a bit longer over here. I already have it pulled up on my other set of slides, so let's go over here and take a look at it. I'm working on two computers. Okay, and I want to take a look at Part 1. Okay, the slide I want to look at, slide 19. Okay, you can review these other slides. Most of them had to do with the quiz that you had on Friday. But on this particular slide, you need to be aware of these are generally accepted accounting principles that accountants use. You need to look at the revenue recognition principle and realize that accountants work under two bases of accounting. One is the cash basis, in which you would have to receive cash. I think I've talked about this in order to record it. The other one's the accrual basis, which means that you can allow for credit. Okay, so public companies like we're looking at have to work under the accrual basis of accounting, meaning we allow for credit. The matching principle in the blue box means that when we pay something, okay, if we're working under the accrual basis of accounting, we can owe for that debt. That would require an accounts payable, but it has to be incurred at the same time that you make a sale. So for instance, if you sold merchandise at Walmart, okay, the expenses related to that, which would be the cashier's salary, the utilities, the insurance on the building, all of that would have to be matched in the same time frame that you would the revenue from the sale. Okay, so that's what, and that's under the accrual basis if you're dealing with an accounts payable. Cash basis would be for smaller companies where you only deal with receiving and paying out in cash. Okay, this purple box, cost principle, means that when you put something in the books, it has to be recorded at cost. And the next slide, I think, has to do with that. Let's see if I can take a look at that. I've already mentioned these, I believe, but in this particular slide, if you look through it, there are a lot of dollar amounts associated with purchasing a building. Okay, and it asks you which one of these dollar amounts would you put in for the value of the building, the asset value. Okay, the only one that's relevant here is going to be the price that you paid for the building, which would be the $150,000. Okay, the $150,000 price. So that's the only one that's relevant in this particular case, and that's what that means. You put it on the books at what you paid for it, and you leave it there until you sell it. Full disclosure has to do with the fact that there are notes to the financial statements. I showed you some financial statements. We looked at several in class. We have 4, remember, the balance sheet, income statement, statement of owner's equity, and statement of cash flow. But after that, there's many pages in the set of financial statements that give you details that go into those 4 statements. So we have to disclose everything fully. Okay, you need to know that set of slides, and you also need to know the set on 21. Take a look at that. These are assumptions that accountants make when they go in to work on the books or to do an audit. The pink box, meaning the going concern concept, auditors, accountants will continue on as if the business will continue indefinitely, even if it looks like they're not going to make it next year. So going concern means that we just go on with blinders. We act as if the business will continue until they decide that it is time to close the doors because they can't make it for some reason. Okay, the purple box down there, business entity concept, means that we need to keep separate checking accounts and sets of books for the business as opposed to the owner. Okay, and that's not hard to do with the corporation. It's more difficult with the sole proprietorship, but keep everything separate. Green box, unit of exchange, is the dollar. Okay, we always want to work in the dollar in the U.S. So when we translate everything over, if companies have businesses in other countries, we consolidate everything and bring it over in terms of the dollar. And I'll show you another slide that has to do with the standard that allows for that. Time period concept has to do with the fiscal year. FISCAL, that's the time frame that the business accepts as their 1 year time frame to publish statements. I told you about Apple running from October the 1st to September the 30th, and we'll look at that. And also I told you about Walmart running from February the 1st to the end of January. That's their fiscal period. It's not always the calendar year. Okay, and then another slide I want to mention to you. If you go down to the very last slide here, not that one, this one, FASB 52, you need to know that FASB has to do with translating foreign currency amounts into our dollar. In other words, Apple has businesses over in other countries. We bring everything over. And when we look at the Apple financial statement, let me just show you one up here. Okay. Notice at the top of Apple, it says consolidated balance sheets. It'll say consolidated income statement. That means that all of their foreign offices are brought over to the U.S. in terms of our dollar, and everything's put on one set of financials. So you need to know that FASB. Okay. Now, with that in mind, I'm going to click off this one. I want to go back, and the next set of PowerPoints that we're going to deal with, things that you need for this class today. You need Chapter 3, Part 2 PowerPoints. We'll be working with that all week. You need this set of ratios that comes beneath that. You need the Bartlett financial statements. That's the one we'll be working on in class. And your homework will come from this set of Apple financial statements. So those 4 items will be what you need for this week's work. Okay? Now, let's get into Chapter 3, Part 2. Okay, and I'm going to come over here because I already have it pulled up. Okay, now let's take a look at what's there. I want to look at ratios. Now, a ratio means that you're taking 2 numbers on the financial statements and you're putting one as a numerator and one as a denominator. Okay, so if you're taking notes, let me just come over here. This is kind of hard to do on my own, but a ratio, okay, where did I do that? A ratio is a numerator, so it's a number on the financial statement that's a numerator, and it's expressed over a denominator. And what we're doing is we're taking numbers that are, flat numbers, and we're putting them in terms of a percentage in order to evaluate them and analyze them against other numbers. Now, there is another set of PowerPoints or a handout that I want you to look at that you need to include in this because I'll be including them in my discussion, and it's called benchmarks. Okay, benchmarks. This is what we use for comparisons. Let's just pull this up. And what I've got here is several industries. Okay, and across the top are the ratios that we'll be looking at. Now, they've given you the ratio in terms of numbers here. Some are expressed as percentages. If you look at the top here, net profit percentage. Others are left as decimals. Okay, but you have several industries. You have the computer industry. Dell, Hewlett Packard are shown here. Then you have Home Depot and Lowe's. That's your building material industry. Then you have your grocery stores, Kroger, Whole Foods, and you have merchandise stores, Sears and Walmart. Now, when you're making comparisons of numbers, ratios, you want to compare within the industry. It doesn't do a whole lot of good to compare Dale to Home Depot or Dale to Kroger. I mean, you can do that, but if you're looking at, I don't know, trying to decide which one's better, it's difficult to do. It's like apples and oranges. So if you're wanting to invest in the computer market, okay, industry, you'd want to look at all of the companies that operate there. Dell, Hewlett-Packard, Apple, IBM, Microsoft. Look at all of those and then make your comparison. Now, if you're looking to invest just in general, maybe it would be okay to look among industries. Maybe you're undecided, but if you're set on investing in computers, you want to look only within that industry. Okay, now let's go back to the PowerPoints. Let me come back over here. And there's 5 categories of ratios. You need to know these. We're going to be looking at liquidity, activity, debt, profitability, and market ratios. The first 2 I want to look at today will be your liquidity and your activity. In other words, we're going to look at 2 that give you a measure of how are we able to pay our short-term obligations. In other words, mostly our accounts payable. Okay, how is a company able to pay accounts payable? Do they have enough cash available? And then the second set has to do with how efficient is the firm? Okay, how quickly can certain accounts be converted to cash? So these are the 2 we want to look at today. And in order to do that, I want to introduce you to your handout that has to do, let me minimize this, that has to do with these ratios. So go to your ratio page here, and I want you to number these ratios. The first 2, the current ratio and the quick ratio, will be your liquidity ratios. So I'm going to come down and I'm going to look at one on a page down here, so bear with me. Okay, so here I am, and the information at the top we're going to hold off on. That's for another day. Okay, I want you to number these ratios, number 1 and number 2, and these are going to be liquidity ratios. Okay, and then I want you to come down, and the next ones, we have inventory turnover would be 3. We have average collection period is going to be 4. Now that's going to consist of 2 ratios. The denominator will be average sales, so make that one 5. Then we have 6 will be average payment period, and the denominator for that will be average purchases. So this will be 7. And then the very last ratio that's going to be termed activity ratio will be number 8. So we want to look at 8 ratios today. So number 3 through number 8 will be your activity ratios. Okay, so let's take a look at these 2 sets of ratios in terms of our PowerPoints. So let me go back up. Bear with me again. Now I want you to find your Bartlett financial statements. Bartlett financial statements. Okay. I want you to notice that we have income statement here, and we have a 2-year comparison of our income statement. And notice 2011-2012 income statement starts with sales. Cost of goods sold is subtracted. That gives you something called gross profit or gross margin. Then other expenses, operating expenses, are subtracted here. and that's going to give you what we call our operating profit. Then you subtract interest. That's going to be your profit before taxes. Then you want to subtract taxes, net profit after taxes. This is also called earnings before interest and taxes, EBIT. So make a note of that on your handout. Earnings before interest and, earnings after taxes. This is your net income. Here's your operating profit, earnings before interest and taxes. Operating profit would be earnings before interest and taxes. Okay, your net profit after taxes is actually your net income before you pay dividends. So I'm sorry about that. Then you have something called earnings per share. We'll get to that at the end of the lesson. Okay. Now your next page is going to be your balance sheet. On your balance sheet, notice your assets. You have a 2-year period here. Assets start with your most liquid assets, which would be cash. Come on down and you'll come to your more long-term assets. Notice your current assets are all those above this line. That means they can be converted to cash very quickly. And then the ones below that, land, buildings, machinery, those are long-term assets. Okay, we have something called depreciation. We've studied that in 210 before. That's where you take the cost of an asset and you spread it over the life of the asset, and you get to virtually write it down to your salvage value. Okay, so fixed assets right here, also called long-term. If you add this number, 2374, to your current assets, 1223, you'll end up with total assets 3597. Okay. Now remember your balance sheet equation. That total assets has to be equal to your liabilities and your stockholders' equity. Okay. Now let's take a look. First, liabilities are your short term, your current. These are going to be paid within the year. So here you have 620 would be 1,000, 3 zeros added here. You have a long term, which means it's going to take us longer than a year. So the 1643 plus the 620 will be equal to your total liabilities. Now, they don't have a line for that, but if you added that, that would be like 2163. That would be your total liabilities. Okay, then you have your stockholders' equity. Now, stockholders' equity consists of your stock. You have both preferred and common stock here, preferred and common. You have what we call additional paid-in capital, which means an amount over the par value. We have retained earnings, which means your accumulated net income minus any dividends. So starting with preferred stock, common stock, paid-in capital over par, and retained earnings, that gives you total stockholders' equity. If you take 1954, you add it to your total liabilities, 1643, okay, that's going to give you 3597, which is the same thing as your total assets. And I may have confused you up here. I didn't realize they had this total, but your current plus your long term is 1643. Okay, I thought we had to add that. Okay, now I hope that's not too confusing. Those are the numbers we're going to work with right off. So let's get into the first set of ratios here using these numbers. Okay, your liquidity ratios have to do with 2 ratios, your current ratio and your quick ratio. Now, if you follow along and you want to do these out, you can do them out on your sheet here. Okay, current assets, current liabilities. Go back to your Bartlett financial statements. Let's find those numbers. Okay, current asset will be 1223. Current liability is going to be 620. So 1223 and 620. Now I'll show you what I did. My screen went black there. I wrote it down right here, 1223620. You can leave off the extra zeros. If you run that through your calculator, what you're going to get is 1.97. Now look at your PowerPoint. They put the zeros on the screen. You don't have to. You can leave them off. It's called truncating them, as long as you leave off the same number of zeros in the numerator and denominator. Now what this means is that for every $1 of current assets, $1 of current liabilities, if you put it over $1, we have $1.97 of current assets. We have almost $2 available to pay off every $1 of our current liabilities, and that's good. You want a general measure of like 2 to 1, depending on the industry that you operate in. So that is a fairly good ratio analysis. Talks about that on the next slide. If you go to your benchmark slide, let's take a look at what some of the benchmarks are. Okay, for the current ratio, Dell Computer has 1.3, Hewlett-Packard 1.2, Home Depot 1.3, Lowe's 1.3. Computer industry overall is 2.5. That means they have $2.50 in current assets for every $1 of current liabilities. And so that's a little bit above average. The current ratios on all of these seem to be low, going on down there. Okay, they should be around 2 to 1. Okay, so they are a little bit low there. Perhaps the reason is inventory. Okay, some have inventory, some don't. So let's take a look at how inventory affects this ratio in the second set of PowerPoints here. Okay, now let's go back to the PowerPoint slide and let's take a look at, where is my PowerPoint? Okay. Okay, what we call the quick ratio. In that formula, you take the current assets, but you subtract out inventory, because you have to sell inventory to be able to get your cash, so it takes longer. So if you want to see just what you have in the quickest form of your ratio, your cash available, subtract out the inventory there. So for Bartlett, if you go, we can look on the slides, but if you go and take a look at it, leaving off the zeros, you could do that. What you have here is the 289 represents the inventory amount. Okay, so let's take a look where you got that from. Okay, come up here to your set of financial statements, and the 289 came from right here. So what you did was to take your 1223 current assets minus 289, and that's going to be divided by, come on down, 620. Okay, so that's where they got their numbers there. Now if you notice, let's go back over here. If you notice, you have 1.51. Okay, that means that for every $1 of current liabilities that you owe, you have $1.51 in virtual cash to pay it. So you can pay off your liabilities and have cash left over. That's assuming you subtract out your inventory. Okay, subtracting out your inventory. So that's good. You want to have at least 1 to 1. Let's take a look at the industry. Dell, notice 1.2 right here. Hewlett-Packard 1.1. The industry overall is 2.1 for computers. Now some of these have a little bit lower. Home Depot and Lowe's. That's because they have a lot of inventory. And so when you subtract out the inventory, there's little left. So their numbers are a lot lower than Dell. Dell does not carry a big amount of inventory. Okay, so that's the difference there. Liquidity ratios, and they can vary depending on the industry you operate in. Kroger Food, okay, doesn't have or it has a lot of inventory compared to Whole Food. Okay, Sears inventory has a lot. So Dell has less inventory and Hewlett Packard does too. Okay, that's a little bit time consuming and a little bit much, I suppose, for the day. We were going to go on, but I think maybe that's a little bit enough for me to start off with. So what I want you to do is I want you to take a look at your Apple financial statements. Okay, take a look at your Apple financial statements. You can find those online. Let me pull them back up for you. Okay, and I want you to go through here and calculate the current asset, current ratio, and the quick ratio for Apple. Okay, so go through there for Monday, calculate your current ratio and your quick ratio for Apple. Okay, so make sure you have 2 sheets of the ratios, the ratio forms printed out, one to work in class and one to do for your homework. And so current ratio, quick ratio for Apple. And I'll pick up on this on Wednesday and we'll finish it up hopefully on Friday. But I think that's a bit, a bit of an introduction there for you, and that'll ease you into it. So 2 ratios for homework. You don't have to submit them. Just do them, and I'll take a look at them on Wednesday. Okay? So I'll post another video on Wednesday, and just keep up. Do Apple. Go through the financial statements and see what you can do for the year 2013 there. Okay? Now you do need the balance sheet and the income statement, so don't get confused. Where are you going here? Come on down here until you get to your balance sheet. That's the one you're going to use. Okay, current assets. Okay, then come on down, find your current liabilities, and you want to find your inventory. So those are the 3 numbers you're going to use for this first set of calculations. Okay, we'll pick up with liquidity ratios, or activity ratios, I'm sorry, on Wednesday. Take care. See you later.